We kick off the show today by taking a look at African Bank. Of course, it's a mass lender and has reported a 20% gain in first half headline earnings per share to 136 cents, while the group's return on equity improved from 15.3% to 17.5%. Now, this is due to moderately improving economic conditions, modest growth in employment and intense competition in both the credit and retail segments. An interim ordinary dividend of 85 cents per share and an interim preference share dividend of 310 cents per share were declared. On that note, gentlemen, thank you so very much for joining me today. Much appreciated. Chris, let's kick off with you. And just chatting to the guys at African Bank, it seems that most of the investor community out there had expected profits to surge around 30%. We know that the share price came under significant pressure when the trading update was released a couple of weeks ago. And it seems when you look at the sales numbers that African Bank was talking about at the beginning of the year, that is perhaps the distortion that occurred where most were expecting better numbers than 20% increase.
That's right, Lynn. If you look at the second quarter versus the first, well, should I say the quarter-on-quarter comparisons, excuse me, there's definite signs of a slowdown and advances taking place there. Don't get me wrong, it's a good set of results, but as you rightly say, a bit below market expectations. And the way I read it is that there's an awful lot more competition in the market in their particular space than there was even a few years ago, which I think is one of the reasons why they're looking to move into different segments of the market. And some people have said, they're moving upwards, moving into a kind of upper segment. But yeah, to be honest, it's not a stock I can get awfully excited about at this point in time, even although
20% growth in profit doesn't excite you,
Chris? Look, they've done a remarkably good job with ailerons. I mean, Syd, I think will give you a much better rundown on that one. But yeah, I can't get too excited about anything in the banking sector, especially the banking sector at this point in time.
I'll tell you the problem. The problem is the dividend. The share price was held up because of management talk over the number of years. The company had excess capital and the company was effectively going to give you back a lot of your capital, especially the capital that was created with the Ellerines transaction, and they were going to give it back to you, and that they could reduce the dividend cover. At one stage there was talk it would even come down to 1-to-1 type of thing. Now suddenly they've changed tack. Now they're going to raise the dividend cover. Our analyst, my colleague who covers the company in greater detail, is talking of the dividend cover possibly going as high as 1.9. So what it effectively means is the dividend may in fact be pretty flat for the next 2 to 3 years. Investors don't like flat dividends because all the share price inherently built into the dividend expectation is now gone because your dividend isn't going to grow anymore. So suddenly, you've got to change your attitude, your calculation, the valuation methodology. And my concern is that share price isn't going to go anywhere for the next few years until the dividend cover kind of normalizes.
That's such an interesting point, Johann. Over to you, your sense on that. I mean, most were talking about the fact that growth is not going to look that fantastic going forward, and perhaps we're looking closer to 30 or even 40% growth. And Syd mentioning the dividend cover, do you think that is the reason that most investors are relooking their investment into Able?
Yeah, I think obviously the business has changed quite a hell of a lot after the acquisition of Ellerines. We've been used to Able generating mid-40s to even 50% ROEs. That has dropped substantially post the Ellerines acquisition. Obviously a bit of goodwill in there as well, depressing the ROE. And I think that feeds through into the dividend. So, and additionally as well, you saw that the regulatory capital requirement went up from 24% to about, from 19% to 24%. They're still comfortably ahead of that, sitting at about 33%. But I think obviously to satisfy their bondholders, and Able is obviously 90% funded by bonds, they need to maintain a healthy buffer above that minimum regulatory capital requirement. And I think that speaks to the lack of dividends going forward. Having said that, the growth story for Able going forward, they're targeting 30% ROE within the next 4 years. Now, obviously, to achieve that, if you're going to maintain your capital base to some extent, it points to some pretty decent earnings growth that needs to come through to actually achieve that target.
Well, Johann, I mean, you mentioned a return on equity. They're looking at around 17.5% for the 6 months to the 31st of March. As you were saying, they're targeting a much higher level at this point. But it seems that the company is relatively optimistic that it can meet these targets. And we know that they've also divided their business units and, of course, the retail unit with regards to Ellerines. Do you think that was the right move?
Yeah, it's interesting. You know, there's two different strategies coming out in the market currently. I think when we speak about Lewis later on, you know, they take the complete opposite strategy. But we've seen JD Group also separating their financial services interest from the retail interest, and we've seen the exact same happening with Able now. You know, so it's difficult at this point in time to actually evaluate what is going to be the most successful strategy going forward. But you know, the fact of the matter is that the consumer finance space is very much a hot space currently. You know, even the big four banks are starting to target that space. So competition is on the increase, and there's a lot of different strategies being applied by the different players in the segment.
Okay, Syd, over to you. I mean, with regards to the competitive environment within the space, we know that Able has opened up various kiosks and also they call them carve-out branches as well. And that being the face-to-face scenario that is playing out, and also perhaps playing out with the likes of Lewis as well. Do you think that that is going to keep them ahead? I mean, obviously they're going to come up with new products and initiatives to stay ahead.
You know, at the end of the day, the Ellerine business is all about selling furniture. It's not selling money. The kiosks are there to sell money. The kiosks have been put inside Ellerine stores for good reason, because they have the captive traffic coming into the stores. And at the end of the day, you've got the trading space, you're paying the rent. And if you can capture some incremental business from that space, which, as I said, you're paying rent for in any event, well, then it's a good sign. But the Ellerine business per se is the business of selling furniture. And Tony Fourie has done a good job in fixing up the business. But unfortunately, when I look at certain key, let's say, criteria, measurement criteria relative to its competitors, its performance is actually very poor. I just want to give you a few pointers. You can calculate merchandise sales per square meter, which is the density, in other words, which is the exact same measurement I would look at with any apparel retailer and a food retailer for that matter. Just to give you some pointers, in the JD Group, the figure runs at about, and this is just the traditional credit, so in other words, we are measuring apples and apples. The figure runs at just over 10,000 rands per square meter. 10.2, I think, was the figure. Lewis runs at about 10,600. The Ellerine business, and what I did this afternoon, and I know it's cigarette box stuff, but I took the core brands of Ellerines, annualized the figures at where I thought it would be for the full year, just the core brands which are measurable against Lewis and JD. The figure comes in at 6,000. It's appalling. In other words, they are 40% short on sales density relative to competitors. Now, as much as Tony's done a good job, he's clearly been spending time cutting costs, and I'll talk about costs right now, a key cost factor, but he's not growing the sales. And that's why his profits eventually are going to come under pressure. Now, in costs, there's an important factor called marketing cost. In my mind, there should be a direct correlation between marketing spend and merchandise sales. Yeah. In the case of JD, JD's marketing spend per square meter is way below that of Lewis. And remember, they got 6 or 7 brands. So you're spending the money across 6 or 7 brands. In the case of Lewis, where the spend is greater per density, but you're spending it effectively on one brand. Now, let's take the figure in Ellerines. The figure is worse than appalling. Ellerines have cut their marketing spend over the last few years, and it's now, takes a bit of time, you know, these things have momentum, but once the momentum runs out, you come to the end of the road. Now, it's my view, now the sales are under pressure until you start spending money on marketing your brands. And remember, we're not talking about one brand here, we're talking about across a few brands. Yeah. That's where I think Ellerines' major problem lies today. It's a good result, but it's actually a very poor result.
Yeah. So where does that leave Ellerines then and Able. I mean, chatting to the guys at Able, again, I allude to the fact that they say they don't regret the purchase, they regret the price, obviously, but they say that it was a very strategic move, nevertheless.
Yeah, conceptually it was fine. They bought it in 2007, they overpaid, and you're right, they admit it. So the question is, now you have a situation where in the banking side, they're looking to move up market. They're working in a very, very crowded space. They've got, as Syd was saying, a traditional furniture operation, which isn't perhaps firing on all cylinders, so it's going to be an expensive exercise to really get that right properly. It does mean there's probably a bit more blue sky built into the thing, yes, but it could take a bit of time, which is why I can't really get awfully excited about it.
So not hot for you, Chris?
Lukewarm.
Lukewarm. Syd?
Well, as I said, I mean, the Able business is classified as a bank,
Yeah.
but right now I think I can invest in better banks. And I've given you all the reasons why.
Okay, fantastic. So not hot. Okay, Johann, over to you. Hot or not? Able, African Bank.
Lukewarm. I think if they deliver on their targets, you know, then like I said, then there's going to be growth coming through. The key is going to be the Ellerines business, getting that business to the levels of its peers. And you know, yeah, if you look at Ellerines currently, just maybe another metric to link to Syd, you know, they're currently turning their stock 3 times. Their competitors are closer to the 6-7 times level. You know, so there's a lot of capital being tied up in that business still. So you know, it's really a question of them delivering on their targets.
Fantastic. We now turn our attention to Lewis. It has reported a 22% rise in full-year headline earnings per share to 781 cents. This was mainly due to improved gross profit margins from 34.9% to 36.3% and a decline in debtor costs. Lewis has declared an interim dividend of 207 cents, which brings the total dividend to 363 cents. Johann, I think let's kick off with you. Looking at the likes of Lewis and also just some of the commentary that we made about Ellerines and the fact that it does have a lot of room and of course a place where it needs to bring in new strategies so that it does reach levels that we're seeing with the likes of Lewis. Juxtaposing these two companies together, your views?
Yeah, you know, it's completely different strategies between Lewis and Ellerines, and I think you can almost throw in JD Group into the mix as well. You know, the first thing is Lewis is very much a customer-focused business. They follow a decentralized model where they work very close to their customers in terms of sales. You know, they're close to their customers in sales, they're close to their customers in terms of data management as well. And then the second part that's quite interesting also for me is that Lewis doesn't run a DC model, whilst we're seeing Ellerines moving into centralized distribution now. You know, so it's completely different strategies being applied, and a lot of commentators out there have suggested that Lewis is going about it the wrong way, that they've got a lazy balance sheet, that they've got the room to actually increase the gearing in the business, etc., etc. But you know, since they've been listed in 2005, they've really delivered in terms of performance, and I think, you know, their sort of strategy seems to work for them.
Chris, your view on this, and we know that they are wanting to ramp up their stores and they're talking about wanting to saturate the local market.
Yeah. Look, Lewis has been a favourite of mine for a long, long time. As Johann says, you know, it's a bit different from the other two. Some people regard it as being very old-fashioned, very conservative, but you know, it has paid off in the longer term. I think what a lot of people forget is that your typical customer at Lewis, you know, has got an average household debt to disposable income of less than about 18%. So, you know, there's plenty of debt capacity in future. And they know their customer inside out. So, you know, it's very conservative, we know that, but at the same time, I like the stock.
Okay, Syd.
You know, a leopard doesn't change its spots, ever. Alan Smart ran that company for he worked there for nearly 40 years. I think he was the MD for nearly 30 years. And he in turn was taught the tricks of the trade by the great Universal stores by the Wolfsons, the Wolfson family. And all that Johann has done is carried on with the tradition. That's why the head office is still in a pretty half rundown part of Cape Town, because there's no need for them to move from Victoria Road, Salt River. And it ain't going to change its way of doing business. There's been a lot of criticism about the way they, as Chris was saying and as you were saying,
Johann, yes.
about the way they do business, the way they don't centralize data collections, the way they don't have distribution centers. But at the end of the day, it works. At the end of the day, Lewis has been the one retailer to report a certain degree of consistency. It's true the profits did go down for a period of time, but there was nowhere near the volatility that some of its competitors have experienced. And I think the market has re-rated the share to give it credit for what it has achieved through a particularly difficult trading period. And of course, if you just look at some of the metrics I gave you just now, you know, at the end of the day, let's forget about the way they do business. Let's forget about their methodologies. The fact is, their merchandise sales densities are better than their competitors. Their marketing cost is greater than their competitors, and yet their total cost ratio, which I didn't talk about just now relative to JD, is still lower than that of JD Group, even though their marketing expenditure on a density basis is higher. Well, they've got to be doing something right, and I think it bears itself out in the numbers. The net gearing of that company, I know the gearing is shown at 20-something%. The net gearing, because they keep a lot of cash and investments in the insurance subsidiary, and that's another one of their one of their operating philosophies, the net gearing is in fact zero. And that's the way they want it to remain going forward. They use metrics such as the net gearing as a determinant as to how fast they can grow.
Fascinating points there, Johann, that Syd made. Any that you would like to comment on? If you could also just include whether you think it's hot or not. I mean, just from some of the things that Syd has been saying, it seems that this stock could be going to the moon if it keeps this potion for success going.
The only aspect that really came out that was maybe a bit concerning for me was when Johann Ensign was asked about his sort of where he sees the total cost. I think it's sitting at 34% of sales currently, if I'm not mistaken, where he sees that settling in the near term or in the medium term. It said it can't really see it improving too much. Now that sort of points to me that there's not going to be a lot of operational gearing coming through in the business. So it's very much going to be a question of how much top line can grow. Having said that, you know, another sort of indicator for me is the fact that the dividends didn't grow in line with profit. Dividends was up by about 15%, if I'm not mistaken, and they've also indicated that they're not going to be doing any share buybacks going forward. So it seems they're retaining a bit of capital, which points to maybe that they're anticipating a pickup and that they want to start investing for growth, you know, start investing in their debtor book and start investing in inventory as the market starts picking up again.
Yeah. Hot or not, Johann?
I think, yeah, it's hot.
Hot, fantastic. Syd.
Not a single one of the things Johann's raised are in fact a problem because they've been addressed over the years. The reason why the dividend was raised at a slower rate than earnings was very simply they held the dividend when earnings went down. They always said that when the earnings turned around, they would restore the dividend cover to 2 times, which is exactly what they've done. So there's nothing abnormal in that. Share buybacks in a furniture company, in my mind, would not be appropriate. Furniture companies absorb cash. Yeah. There's no ways you can utilize excess cash to buy back shares. In fact, if you've got excess cash, you're not growing fast enough. What will prevent Lewis from going berserk in their growth is the self-imposed gearing limit, excluding the cash in the insurance subsidiary, of 35%. They've always said that they will not exceed 35%, but the trouble is this, because you're consuming cash, you can only grow at a level which in fact is dictated by your rate of cash generation, and therefore they can't go berserk in their growth. And it's probably correct that the operational gearing is out of the system now, but it doesn't mean that it's a bad business.
Okay, we're running out of time. Hot or not?
I think it's a hot stock, but I don't think you're going to get much capital appreciation in the next year.
Okay, hot or not?
Low PE, high dividend yield, hot stock.